monetary policy impacts of that decision. I was wondering how you respond to the concerns voiced by your former colleagues John Vickers and David Aikman that this is a mistake because of the threat of increase in financial instability.
Yes, I mean, I think the important thing is to sort of put into context how we arrived at the 14 to 13 change. And let me start by saying we come at this from sort of two directions. One is one is top down and the other is bottom up. This, of course, is the top down judgment. The bottom up is the one that PRA lead on, actually, which is to formulate the capital requirements piece by piece. But we do aim to keep the two consistent, because otherwise that would be somewhat challenging. And so, since we did the last assessment, two things had changed in the sort of the bottom up, which add up to 1%, and it's about 0.5% each, actually. So the first one is that when Basel 3.1 comes in, we think that we calculate the benefits of the better risk assessment in Basel 3.1 is worth about 0.5% off the sort of the buffer that we maintain in what we call Pillar 2A, which is the sort of the thing that's there to account for the things that we don't measure very well. So we think there's a benefit there of about 0.5%. The second is that back when we did the last assessment, another piece of the buffer structure is what we call the systemic buffer for the globally systemic institutions. Now, there had been an assumption when we did the last assessment that that buffer would increase by about 0.5%. That's really saying that the UK banks would become more systemically significant over the period ahead. The systemic buffer calculation under Basel is actually a relative calculation, so it's your banks relative to other people's banks, as it were. Actually, they haven't, is the answer. The UK banks have not become relatively more systemically significant. So again, there was a sort of 0.5% put in, which really isn't justified by what's actually happened. So put those two together, and the bottom up is about 1% lower. So when we looked across the piece from the top down, we felt that it was sensible bearing those two things in mind, which I say both of which in a sense are a measure of risk assessment, slightly different angles on it, but measure of risk assessment to align the two, and therefore we felt comfortable with bringing it down to 13. Now 13 is at the sort of towards the lower end of the range that we think for top down. We put a range about 12 to 16. The other thing I was thinking, and I think Dave referred to this last week in a speech he made, that there is an important element in here for the benefits that we think the resolution regime gives, which otherwise, if we did assume for a moment we didn't have the resolution regime, we think would have to be reflected in more sort of continuous bank capital, and we think that's worth about 5%. So when we did the previous 14%, we actually said without the resolution regime it would be 19, but we have got the resolution regime. And the resolution regime is important as well. I'll come on to John Vickers' point. Because we've said many times in this committee that that's the way we really believe we've got rid of too big to fail. We've got rid of the dependence on public money. Now, I think there's a genuine difference of view here with John Vickers and David Aikman. I don't think they believe fully in the resolution regime. No, they're entitled to do that, but that's not our view.
Okay. Thank you, Mr. Bailey. I was wondering if any other members of the panel had any concerns about this lowering of the capital requirements.
Mr. Ramazan.
Yeah, can I just reinforce the point about the resolution regime, because that's one of my executive responsibilities, is overseeing the bank's role as the UK's resolution authority. And over the years we have, first of all, it was put in legislation about 10 years ago, and we've actually applied that resolution regime through the regular resolution assessment framework engagement that we have with the systemically important banks, and it's through that process that we have, and as well as obviously through the legislation introducing bail-inable debt, the MREL regime, that we have given ourselves that assurance that the resolution regime is credible and effective. In addition, and as Andrew says, John Vickers and David Aikman they're entitled to their judgment. They don't think the resolution regime has been tested, but I would argue that it was tested. It was not with a GSIB, but when we resolved Silicon Valley Bank UK in 2023, there was no risk to public money through that. John Glenn is nodding at that. He was
very efficient.
Yeah, and that the contrast there with the 137 billion of public money that had to be used during the global financial crisis is very distinct, and I think all of that gives us confidence. Particularly when I'm on the FPC, I've got various responsibilities as an FPC member, but that resolution judgment is a critical one, and I would say it is a big difference between us because they highlight that there is less fiscal space for the government. This isn't about fiscal space because we have a resolution regime to substitute for that fiscal space that was used up during the crisis, global financial crisis.
Thank you. So Dave, just to go back to your letter, you mentioned the decision to cut its benchmark should make banks feel more comfortable to deploy the capital they have and support growth in future. And I was wondering whether this measure came about as a result primarily of a search for measures to increase growth, or whether it came about as Mr. Bailey suggests, the start of a bottom-up review, and growth was simply the kind of potentially happy by effect of that search.
I've been on the committee for 8 years now. We did the last review of capital 5 years ago. I think this kind of 5-year frequency is sensible. So when we decided we would look at it again last summer, I was fully supportive of that on its own merits. And as the FPC, and also because I'm a PRC member, we always, our primary objective is financial stability. And then we have a secondary objective on the the bottom-up PRA, PRC. We think about it in terms of the secondary growth and competitiveness objective. But I'm always putting financial stability first, and it was through that lens that I approached and contributed to the capital review.
If I could just add, there's a bit of a philosophical point here. I think you have them in. If you have the industry in, they will assert very strongly that you'll get more growth by having less capital. I don't think John Vickers and David Aikman will mind me saying, I think they would take the reverse view that more capital is a sign of strength which will support growth. My view certainly is, look, you don't get growth without financial stability, but we shouldn't be seeking to have more capital than is consistent with financial stability. And that's an important philosophical issue that runs right through this debate.
And in my speech last week, if I can just add, I stressed that there is a trade-off here, and there's a balance to be struck. But I felt comfortable with the decisions we made. Just responding in the letter I wrote you on the detail, which follows up on an exchange with Dame Harriet when I was at the committee back in December. As to what will actually happen will depend on the balance between demand and supply of lending. We don't get any sense that there are any constraints out there in terms of the supply of, that doesn't come back from our various surveys, that it's supply that's holding back lending. It will be a question of how banks behaviourally respond, whether there is an impact on the real economy that would then bring it back into the Monetary Policy Committee space.
So you don't think that supply is an issue right now? That's your assessment.
It's not a significant issue. No, it's a judgment. It's a judgment, but I don't see any sense that across the economy at the macro level, we go at some length in the latest FSR to highlight that for some, SMEs have had issues with getting capital for 100 years. Nearly 100 years. We quote the Macmillan report from the 1930s. For high growth firms, there are issues with going from start-up to scale-up. But I would say at the macro level, which is what I was answering the question on, because that was in a kind of MPC context, but certainly in terms of what can be done at the micro level for particular segments of the economy, particular firms that you want to really contribute to growth, like high growth firms. I'm not saying it's not, there are a whole series of issues, but at the macro level, I would.
Okay, so you do think that at the micro level that banks could react to your reduction in the capital requirement by increasing lending to productive parts of the economy and therefore boosting growth? Do you think
they could well do?
Yeah.
John Glennon.
Yes. Can I just acknowledge to your points, Dave, that absolutely in 2023 there was a very efficient resolution, and there was a seamless operation on that. But I think the received wisdom I get from people in the city and banks is that we had a system set up after the last crisis, and to some extent we haven't reset in the world that we now operate in. And I think the governor alluded to this, that the industry would possibly want to go further. Could you, one of you, explain how you see what that step versus what's happening in the EU and the US, and how we look in terms of global competitiveness? Are we actually addressing the world as it is now, or rather holding on to a regime that was set up 10, 12 years ago on the basis that this now must not change, otherwise we'll get into the risks that we had in 2007-8? Because it feels like for many in the banking sector there hasn't been that shift, and the binding requirements to work through from that 14 to 13% that presumably the PRA are responsible for, that hasn't happened yet. So, how would you address the concerns that exist in the banking industry?
Well, funny enough, the PRA has published the Basel 3.1 documentation this morning, so it is.
Oh, right.
It is
that's timely.
Well, you're seeing them tomorrow, I think, so you can.
The bigger point I'm making.
No, the bigger point is, a couple of points. Implicit in your sort of opening point about the industry is a view that, okay, we had a global financial crisis, you had to respond to it, but that's all over and done with, and move on. And I would push back to a degree on that, because of course the underlying issues never go away, which is the underlying what's the right level of capital for this level of activity. So I do push back a bit on that, frankly. The second thing I would say is, and we devoted a lot of space in the publication to this question about, how do you compare levels of capital, as you said, across the EU and the US being the good cases in point. Because the industry, does assert frequently that we have a higher capital ratio. We don't think we do. We've published far more of the sort of the entrails of the calculations in this report. And happy for the industry to sort of publish its views and push back if they wish to. I haven't seen anything yet, but no doubt they're working on it. So if they want to do that, that's fine. I would say this: the devil is in the detail on doing this stuff. It is. If you take the example of the US, a lot of the important detail in the difference between us and the US in approach is that the US actually has a very different approach to risk weighting than we do. There's a thing called the Collins Amendment, which essentially which is done in Congress, which sets a floor on risk weights, which is higher. And you have to take that into account to essentially calculate like-for-like risk weights, which we've done in this calculation. But I've always cautioned to the industry that if you do simple headline numbers, you don't capture the detail, and you have to do that. But we're happy to receive, whatever feedback comes.
And if I can give you an example of devil in the detail, coming back again to the resolution regime, I would say that we have evolved our approach, and the focus actually of my speech last week was about that we've tried to be responsive to changes in the risks as we see them, particularly affecting mid-tier banks that are growing. We made a number of changes last year to the thresholds at which the requirement for MREL, for that bail-inable debt that protects the public purse, kicks in. When we originally set the regime, it was 15 to 25 billion, and we've moved it up to 25 to 40. And we've also, within the way that we then apply it case by case, we've actually looked at some banks who had transfer strategies, i.e. they did have to raise some bail-inable debt, and we've said actually they can come out of the MREL regime altogether because their business models look relatively simple. And we announced just before Christmas the particular banks, I won't name them, who had and a building society who moved out of MREL. But more generally, we engaged very strongly with the mid-tier population. You'll remember from when you were economic secretary that is a group that is very keen to engage both with the Treasury and with the Bank of England. And their response to our changes was, I would say, generally, they certainly felt that they had been engaged with. I wouldn't go as far as to say it was unanimously positive, but they recognised again that we were balancing, and we sometimes get challenged that our thresholds are still lower than in the euro
to us.
But both in the euro area, the banking union has a very, very significant pre-funded bailout fund. The single resolution mechanism has got like 70 billion. Yeah. We've got the FSCS with $1.5 billion. So, and again, in the US, they have a very different, you can be much more confident that a bank will be taken over because just how big the banking sector is. And they also have a much more significant deposit protection scheme. So we're balancing off, including against risk to the public purse.
Thank you. That's a very good.
A very, very helpful exchange. Thank you very much. John Grady, MP.
Thank you very much, Dame Meg. Governor, obviously been lots of developments over the last few days with Greenland, including the prospect of a potential invasion and further trade disruption and trade wars. How concerned are you about what's going on there and more generally US political risk and its risks to the financial stability of our economy?
Well, I would say amongst the risks that we see, and as I'm sure you know, in the financial stability report, we highlighted that the risks to financial stability increased across last year. I do think that geopolitical tensions and trade, particularly trade issues, are an important part of that. Now, that does not mean to say that I want to say that any particular issue is a trigger. But the level of geopolitical uncertainty and the level of geopolitical issues is obviously a big consideration because they can have financial stability consequences. I think, but let me put that into a bit of context, though, in two respects. One, having said that, growth in the world economy last year was a lot more stable than we thought it would be. If we probably were having this conversation if you think back to last spring, say, almost not quite a year ago, but almost a year ago. Growth in the world economy and the stability of the world economy turned out to be rather better than we feared it would be. That's the first point. The second point is about financial markets, and it's a rather similar point, which is, it is the case that we worry, considerably about how markets can react to these things. Market reactions have actually been more muted than we would have feared and expected. But let me put the final thing I'll say overriding that is that having made both of those points, neither of them I take as a source of any assurance going forwards. We have to remain very alert to these things.
And related to US political risk, obviously you signed, along with various other central bank governors, a letter in connection with the criminal proceedings against the governor of the Federal Reserve. Would you like to outline in terms what your concerns are about the criminal prosecution against the governor?
Well, it was a series of subpoenas. Yes, let me be very clear, of course, it is not for me or any other central bank governor in any other country to intervene in a domestic US issue. However, the US, and particularly the dollar, is a different case for the following reason, that there are substantial externalities and potential spillovers from things that go on in the US. And particularly, I would say, from a threat to the independence of the Federal Reserve. The Federal Reserve obviously is the largest; it's the central bank for the largest economy in the world, but it's also particularly the central bank for the world's reserve currency. So I would think, if you think back in time, probably the two most famous comments ever made about the dollar are both made in the 60s and 70s. One was made by Giscard d'Estaing when he described the reserve currency status as the exorbitant privilege. And the other one is the famous comment made by John Connolly when he was US Treasury Secretary in 1971, it's our currency and your problem. But the point is that there is very substantial scope for spillover, and it goes back to your point about point I was making in response to your first question about financial markets. So it is, of course, therefore a concern to the rest of us, and I think we do have to highlight that point. So it is pretty unprecedented for other central bank governors to do this, but I think it's a point that we have to make in this situation. But as I say, we have to be careful what we do. Now, I will say also, because Jay Powell is a close colleague and a friend of mine, actually, that I've said before in public, and I'll say it again, he is, in my view, a man of the utmost integrity.
Thank you, Governor. And then, whilst obviously the focus of a minute is on political developments with the US, there remains material concerns about China taking action against Taiwan, so a blockade or an invasion or something else. Is the FPC satisfied that it's got a firm grip on the risks in connection with such things?
We spend a lot of time on those issues. Obviously, it's no secret that the UK has two large banks which are, by history, heavily committed in those markets. We obviously have a very open economy, which is, again, deep history in this country, and in many ways a good thing. So we spend a lot of time on these issues, and yes, that is obviously part of that. So a very important part of our consideration and the work that we do.
And if I can just add on, we're also, compared with sort of previous eras, particularly thinking back to the global financial crisis, the interaction between financial stability risks and fiscal positions is much more front and centre. It comes back to the discussion of fiscal space, which in the context of bank capital I don't think is an issue, but in the context of the core markets where the kind of spillovers that Andrew's talking about would manifest. When we look across although last year, even with financial stability risks increasing, markets were on balance relatively they were certainly orderly. There was volatility. I think we're in an era of volatility in those markets. But it was, for example, after Liberation Day, it was those core treasury markets where we saw real disruption that spilled over into our gilt market. And so, again, to Andrew's point, when you look at this year so far, those core markets for US treasuries, for UK gilts, for euro area bonds, the pricing is very little changed actually compared with where it was last year in terms of yields, etc. And there is not much evidence of volatility, but that doesn't in any way stop us keeping an acutely close eye. I mean, actually, the one exception for other reasons is the Japanese, the JGB market, where a combination, which we highlighted in the FSR, of a new political setting plus traditional Japanese fiscal position. JGB yields have actually doubled over the last year at the 10-year maturity. They've gone from something like 117 basis points to 2.35. So, there's always something new to keep an eye on where and that also impacts back onto us, as we saw at times last year. What's happening in the US market, the Japanese market as well, can impact back on us. For example, the role of hedge funds.
There's just two further points I'd make, and this is, in a sense, what may help to explain why markets have been probably less volatile than you might expect. I mean, the first point is that in terms of trading geopolitical risk, I mean, traditionally there are two things you can do. You can go long the dollar and you can go long gold. But of course, if the problem's coming out of the US, going long dollar isn't the obvious thing to do. In fact, if anything, what we're seeing is quite a lot of hedging of what had previously been long dollar positions going on, in other words, going the other way. And that leaves gold. And of course, we are seeing that in the gold market, because gold is essentially a sort of an agnostic asset in terms of nationality. But it cuts off some of the sort of the geopolitical trading opportunities by not having the dollar there as the option. The second thing I'd say is I think the markets also, I think one of the challenges they have is they see these announcements being made and then they say, but does it follow through to action, or are there sort of restraining forces in there? I'm not saying I'm a believer in this sort of trade notion, but what they see is, did the tariffs actually follow through to sort of some of the more extreme things that were being said or not? And they're trying to make judgments on that all the time.
And that's obviously what did happen after Liberation Day, that there was, the US authorities reconsidered. And so, as a result, the market volatility that we saw and was worried about globally calmed down.
Hey, thank you very much.
Thank you very much, Mr. Grady. Luke Murphy, MP.
Thank you, Chair. Mr. Bailey, in response to Mr. Grady's question about the prosecutions in the US, you referred to the importance of the independence of the Fed. I just wondered whether you perceived or recognised or felt any similar threats to the Bank of England's own independence, and whether you have a strategy to mitigate them.
Well, I mean, obviously, our independence is very important. It's just as important, actually, in our context. I'm very pleased to say I don't see the same threats to the independence of the Bank of England. But obviously, it's something. By the way, I mean, and by the way, can I just say, I mean, our accountability to you is an important part of the independence of the Bank of England. So, the fact that we do our job, but we also have robust accountability, robust democratic procedures, is a very important part of this. So, thank you. But no, I mean, our system, I'm pleased to say, from where I sit, looks rather different.
Thank you very much, Mr. Murphy. Bobby Dean, MP.
Yeah, just to follow on that, I mean, obviously the threat to the independence in the US came about as a result of political change, and you said that you feel quite secure in the UK right now. Do you feel over a 5-10 year horizon it looks secure, or is that starting to become questionable?
You won't be here then.
I'm not sure I'm going to enter into speculation on what might happen in domestic politics.
But I mean, I'm not talking about specific parties, I'm just talking about in general. There's been a mood change across Europe, across the Western world. Lots of institutions are breaking down. Do you see that as a potential threat to the bank?
Well, I made some remarks last week which we published, and I did make a sort of a point about so-called populism. And one of the things, I thought there were sort of three things that I sort of, in the economic policy world that I associate it with. And the third one was what I call encouraging a decline in trust in institutions. Not just us, I mean, that's a much more general point. By the way, I've deliberately said institutions, both domestic and international, because it applies to the international world as well. Now, look, that's something that we have to take very seriously, and I think, we have to do our job, and, we have to hope we seem to be doing our job well, and we have to explain ourselves transparently. But I do see that is part of the what's grown up in that world, and yes, we have to take it seriously, and I think I hope present sort of serious rebuttal of that point.
I do think it's worth emphasising the importance. I think, as Andrew just has, that we're almost doubling down on transparency and accountability, trying to get more material out there. If you look at how much we published on the Capital Review, something I was discussing with you back in December, if the focus on our balance sheet, on what we're doing with the asset purchase facility, trying to be more and more transparent, but also accountable. By being transparent, it gives people more information to then come back and ask us questions. And I think, that's one thing we can do in response to what's going on is to continue to be as accountable as we can, and to get information out there to explain not just what we're doing, but why we're doing it.
Thank you. I'm going to move on to talk of an AI bubble. I don't think you use that term in your stability report. You talk about concerns over materially stretched valuations.
Yes.
And you compare that to the dot-com bubble.
Yes.
So can you explain to the committee, what do you mean by materially stretched, and how do you calculate that? How do you understand? How do you come to that conclusion?
Well, I mean, there's a number of ways that you can seek to calculate, particularly the risk premium in equity markets. One of the ones that we use is something called the cyclically adjusted price to earnings ratios. If you look at those, I think what it tells you for the UK, we're at about sort of the 10th point of the percentage points in the distribution, if you like, sort of one end of the distribution. I think the US is nearer to the 5th percentage, so they're more stretched. Now, comparison with the dot-com period obviously is an obvious one to make. What I would say is I think you've seen some similarity in valuation moves. I think there is a difference in that I think far more of the industry we're talking about here, tech and AI, has earnings attached to it at the moment than was the case in the dot-com bubble, where there were a lot of companies being valued way before any earnings were coming along, and that didn't end well for quite a lot of them. But I think the key point then that follows is that there is now obviously quite a big dependency built into those valuations on the continuing stream of earnings that AI will produce, a robust, solid, and continuous stream of earnings. And that, of course, will come down to what impact it makes, what productivity impact it makes. It's in the nature of things, of course, that it's unlikely that all of the companies will be winners. I mean, that would be an unusual situation in any competition situation, but that's not key to it, really. The key is that in aggregate that they continue to produce those earnings. What I would say, and this is more a point about the US, really, because this is obviously most evident in the US. I mean, if you look at the S&P 500, I mean, something like, nearly 50% of the index is in this world now. The dependence on those valuations and that stream of earnings, therefore, first thing I'll say is, I mean, there is a very substantial, therefore, wealth effect built into the US economy, which is supporting growth in the US economy. And if there were any reversal of that, then that would be significant. And it's a much bigger wealth effect than you have currently in the UK economy. That's it's not the same. But again, going back to the point I was making earlier about spillover, we can get spillover from the US.
So with that stream of earnings, I mean, I think I saw a JP Morgan report a few months ago that speculated about the cost of AI infrastructure. Obviously, you have to physically build things, and there's energy costs associated with it as well, versus the potential revenues from AI. They were saying that someone like an Apple might have to charge $300 a month for an iPhone to ever hope to make their money back over a reasonable timescale. Is that the sort of thing that the bank would look at and say, well, that doesn't seem realistic to you? And is that why people are talking about a bubble?
No, we do look at that, actually, because I think there are several issues in there. I mean, one issue is what is the economic life of this infrastructure, and how confident we can be that we know what the economic life of this infrastructure is. Because one of the things I think we can all observe, I see it in our own investment, the economic life of this stuff is shortening. So as AI moves very rapidly, what is the expected life of the supporting infrastructure? That's one point. And allied to that, of course, is the question of, as you said, there's a vast amount of investment in data processing power. I don't know, how likely is it that there is going to be some further innovation that will say, actually, we've actually innovated around the need for all that data processing power, which, of course, in economic terms would then lead to a very different valuation of it. So there is a lot of uncertainty around that, I think it's fair to say. I mean, it's understandable why in the current circumstances this investment has to happen, but there is a lot of uncertainty around its economic life and value, certainly.
Yeah, can I just add on to the question? Do we think that some sort of correction is inevitable over the medium run, even if it doesn't happen, say, this year?
Yes, the point I wanted to make is that what we tried to bring out in this particular financial stability report is looking forward. As you said, there's a huge amount of investment. There's 3 trillion, 5 trillion. These are absolutely huge numbers. And the estimate is that potentially half of that has to be funded via debt issuance. And so we're moving from a situation where AI has been sort of self-funded, equity-funded, earnings-funded. This huge infrastructure spend is going to be 50% funded by the debt markets. And what that does mean is that if there is a potential correction, as the governor was saying, if at the moment there's a correction, obviously there's a sort of wealth effect, there's financial conditions tightening. But if you were to sort of overlay 2.5 trillion of debt related to those earnings, then at that point, if there was to be a correction, there'll be a much sort of broader impact into the debt financing markets as well. And so you have these sort of two. Obviously, we're not timing the calling of any potential correction. And at the moment, earnings are coming in extremely strong, so the valuations are being maintained. But if there were to be a correction now, it would be sort of focused in the equity markets. If there were to be in the future when there's significant debt, then that would be a much broader impact.
Ms. Oakes, do you have anything to add?
I concur with John's remarks, particularly around the debt market side of it. I think the other thing is just the question of how it expands and what sectors of the market are impacted. So we see, huge productivity gains in particular areas like healthcare, for example, potentially. But it's far too early to say where is this going to, directionally where this is going to land, and therefore which sectors of the economy would be most impacted by any structural shifts or any particularly swift corrections.
Yeah, one quick one from Mr. Corbyn.
Ms. Oates, just on your point there, you said you are actually seeing productivity gains coming in, and as Mr. Hall said, as you're seeing the earnings coming in as well. So, do you have to differentiate between this and dot-com bubble, where in the dot-com bubble, of course, the earnings weren't coming in?
Yes, it is very structurally very different. I think it is difficult at this early point to determine precisely where those productivity gains are going to be spread across the economy, but there are definitely sectors that are seeing specific uplift. Healthcare is one that's very clear, I believe, but it's not easy to determine right now which are going to be successful and which are not. I think the other sector, clearly the tech sector, in terms of just code writing, code development, etc., is having material impacts on productivity.
Thank you very much. Jim Dixon, MP.
Yep, thank you very much. Dame Meg, just returning to the US for a second, we talked about political instability in the US and how things like that leading to issues around tariffs and trade could potentially pose a risk to us. Just the aspect of public debt rising that we see in the US. How do you assess that risk to the UK? For instance, is there a possibility of a US public debt crisis that might have a spillover effect to us?
Well, I'll start with the general points that in most certainly major economies, there has been quite an expansion in the stock of public debt, including, by the way, in the UK. You'll be very aware of. And so public debt ratios have increased. Now, that is true also in the US, and the US public debt ratios are higher. The risks around that go back to a point I was making earlier. I mean, one reason why the US, of course, can sustain that is because of the externality, because of the dollar's position. And so there is global demand for dollar assets. This is the exorbitant privilege. What, of course, it's much harder, but there is a lateral limit to that. And what is much harder to judge is exactly where that limit is. And that limit will, of course, be affected, as I was saying earlier, by obviously the attitudes of investors around the world to holding dollar assets. So far, I would say we've seen, as I was saying earlier, we've seen more in the way of hedging dollar positions than actually outright. We don't want dollars. But I think that's the risk, that starting from a higher level, and with the projections based on US fiscal policy projections taking it higher, so that the US can sustain more of that because of their external position, but there are limits. And this is very much, I'll finish by saying, this is very much part of the debate about global imbalances. I mean, the part of the debate that gets much more attention, obviously, is particularly the issue with China and its external surplus, its trade surplus, its very substantial domestic investment position, which supports that export surplus. But the other side of that is the US position, which is supporting a deficit, which is a good deal of which is attached to the position of US fiscal policy.
If I could just add on this, I mean, I think it comes back to what Andrew was saying about the exorbitant privilege and safe assets. I mean, typically, when you have these episodes of kind of risk off, so these kind of safe haven assets, such as the dollar, gold, in the past, because of the size of the market, US treasuries. So you have those kind of well-established correlations. And I think over the last year, what has been interesting, I think this was talked about a lot at previous hearings of this committee. We've seen some of those correlations, being challenged more and breaking down. So actually, US Treasury yields have not fallen necessarily when there have been these risk-off periods, and the dollar hasn't necessarily appreciated. The one asset that has done very well throughout this period is gold. And I mean, the IMF, I think they did an update yesterday, but I mean, just back to this point about, the US debt to GDP ratio, the gross debt to GDP ratio is estimated by the IMF to rise to 143%. That's significantly higher, I think, probably than ours, although ours is also significantly higher. But also they're running significant deficits. And so there is a huge financing need for both that existing debt and the additions to it through the US Treasury market. Why we focus, we often talk to you about the gilt market, but these spillovers that Andrew talks about are, increasingly we're seeing US yields that might rise, and we see the consequence in our yields rising. So, these are, it's right to focus on these. It's not just a US issue at all. In the report, we talk about Japan, we talk about China, talk about France. We're very conscious on this committee and at the bank of the UK's fiscal position, but there's an awful lot of sovereign debt in the world, in developed economies, and it's increasing.
Thank you. Thank you very much, Mr.
And there isn't a world in which reduction in demand for US government debt could be helpful, because it might increase the demand for UK government debt and therefore shore up the price of gilts for the UK.
Wouldn't see it working like that given our relative reserve currency statuses. I think it would more suggest worries around the US, which would then have negative consequences. I think one thing to stress, though, so far when you talk to people in the markets, particularly asset managers, investors, I think the move we've seen so far, at this time last year, and it comes back to things like the AI boom and all of that, the US's resilience, I think most asset managers were probably overweight US assets, including treasuries. And they may have looked again at that portfolio and moved back to something that's more balanced, and some other jurisdictions would have benefited at the margin. So that kind of correction or adjustment is okay. But I think the kind of scenario you described, I think, and back to what Andrew was saying about the Fed, for whatever reason, an undermining in the sense of the US would not be good at all for the global financial system or global economy.
But just quickly add on that, to go back to the correlation point. If you think about it as a UK investor, if you're investing in US assets, maybe you think that tech stocks are still good value, then when dollar was inversely correlated to sort of the risky assets, then that provided a hedge. Yeah. And so it meant that if you were a UK investor investing in US tech stocks, for example, then the currency would reduce the volatility, reduce the riskiness of that position. And so the correlation shift we've seen that's gone from kind of negative to, let's say, zero at the moment, maybe even positive, means that the riskiness of all of those trades has gone up. So the overweight was a natural response to the fact that the dollar, the currency risk, was a hedge. And so the reduction in that overweight is just a natural response to the fact that the riskiness of everyone's positions went up. Yeah. And so I think that is a sort of headwind to the US going forward, unless that inverse correlation reasserts itself. But that's very different from, complete kind of de-dollarization or a loss of reserve currency. It's more of a technical.
Chris Coughlin, MP.
Thank you, Chair. So on that, I mean, I'm thinking sterling was, of course, the world's reserve currency for decades after the UK stopped being the world's dominant economic power. I mean, would you see a similar scenario for the US in terms of the reserve currency?
I mean, I think from a financial stability perspective, what's really important is whether there's a gradual shift or a really abrupt shift. And, what we have seen in terms of reserve currency over the years since like the 70s, it's just sort of gradually been declining in terms of the amount of transactions that are happening in dollars. And so that hasn't caused any financial instability. But if there was to be a very sudden, event, let's say related to Fed independence or some other sort of geopolitical event, then obviously that could cause financial instability. Of course, we're not calling for that. We're not predicting that at the moment, but it's certainly something.
If you just, I'm just going to. Do you want to? You're probably going to make. You go ahead. You're the governor.
Well, I have a couple of points. Just to pick up on John's point, I think if you go back to the 1970s, I think the dollar's share of global official reserves was about 80%. I think today it's about 57, something like that. But the point I make, I think that there is more to being the reserve currency than just how much the currency is traded. An increasing part of the status now is actually providing what I call the world's safe asset, in other words, US treasuries, which are used extensively by markets for collateral and security. And there's two things I'll say about if you ask the question, well, what's the alternative to the dollar? First is that the Chinese currency is not fully convertible, so it's not in its current state going to be, I think, an effective competitor in that sense. The second thing is about the euro. I don't think the euro area mind me saying this, and it comes back to the point about safe asset. The euro area doesn't have a safe asset in the same sense because they've never agreed to have a pooled government debt instrument. So, the nearest you get in the euro area, say, is a German government bond. It's not actually a euro area government bond in that sense.
Okay, Mr. Coughlin.
I'm glad to be so popular today. Ms. Oakes, talk about the scenario the governor's outlining. Could we be looking at a basket of currencies potentially being reserves? And if so, could sterling be more widely used as a reserve currency, and could that actually benefit UK debt?
Well, there were various attempts to do that.
It's actually Ms. Oakes, actually. We can always bring him in, Governor.
But you'll do it. The SDR at that point.
We're just talking about transparency and openness about bringing in the independent members.
I think I'd probably look at it from a slightly different perspective, which is that the world has changed since the 1970s, but we've also introduced sanctions on a number of large economies, and they will seek to do trade to trade with each other and with other countries globally. And so if the US dollar was fundamentally being used as the underpinning for much of that trade in the 1970s, that has shifted. And so as sanctions have increased and the world has got more complex in terms of that international trade, many countries have looked to diversify. And so I think we will probably see absolutely a basket of currencies, but I think it'll include potentially more currencies in Asia than potentially just the Chinese currency. And I would understand that is a rational response for many of those countries to what they see as a shift in stance and policy from the West. As to their trading intentions. So I think it's a natural thing that is occurring in the globe.
Mr. Coughlin.
And would you see the change in the behaviour of the US dollar that Mr. Hall outlines as perhaps the biggest indicator that we're shifting away from the US as a reserve, or most concerning as a reserve currency? In terms of the dollar is acting less as a safe haven asset in times of crisis.
I'm not sure I'd see it as a concern in the same way that my colleagues have outlined. I think it's the question of whether it happens very quickly or whether there's a sharp correction or whether it's just a gradual shift. I think gradual shifts have historically happened over time, and we haven't seen any major financial stability issues as a result.
Thank you very much.
And Governor, I think recently you raised concerns about borrowing the level of hedge fund borrowing in UK gilt markets, and it's a small number of hedge funds. Could you just briefly outline your concerns and how much concern should we have in this area?
Well, it's not just the gilt market, by the way. This is true of pretty much all major government bond markets. So there's been a huge change in, frankly, the structure and nature of intermediation in government bond markets in the last sort of 5 years, really, certainly 10 years. And they are now dominated by non-bank institutions, and hedge funds are a very big part of that. Now, what the structure of the market we tend to see these days, therefore, is a market where hedge funds, and as you say, a relatively small number of hedge funds are taking very big positions in what I call the cash market. So they are actually, they have the gilts, as it were. The asset management industry, which is a bit different, tending to want to take positions in futures. But this market development, I'll be quite frank, has enabled, a lot more debt issuance. I mean, it's a structure that is supporting a lot bigger market in that sense. And of course that, I'd say it's not a UK point specifically, but all governments are therefore benefiting from the ability to issue more debt. Now, the question we have to face is that a robust structure from the point of view of financial stability? And I'd highlight two things in there. Let me make another structural point before I highlight two things. First of all, in terms of the liquidity of this market, it is still supported by the banking system and, of course, ultimately by us. In terms of our provision of reserves and ultimately the banking systems, particularly through the so-called prime brokerage activities of banks, because banks are funding this stuff. Now, two things I'd highlight. The hedge funds, there is a maturity mismatch. They're funding these big stocks of gilts through the repo market. Yeah. They tend to have, the gilts have a longer maturity than the repos. So there is a risk built into that as a maturity mismatch. And then the second thing is the degree of so-called initial margining that takes place to protect against movements in prices. A lot of this activity, say across the world, is done on very low margins. The risk that creates is you get very pro-cyclical margining, because when you get a shock in the system, the margins go up, and because they don't start with the sort of the stock, they're going up more suddenly, and they're going up more when things happen. And we saw some of that, didn't we? Last spring we saw some of that going on. Right. And because these activities are now very connected between markets, because it's often the same funds that are in different markets, you have to watch out for sort of what I call spillovers between markets. And we saw a bit of that going on last spring as well.
And I think if I can just add, because and the reason that Andrew is referring to episodes of where volatility risks turning into disorderly markets. I mean, in normal times, the role of hedge funds, all these other non-bank financial institutions and their connections back to the bank, these are a feature of the market. These are not a bug. Yeah. These are critical to market functioning. I think our worries, and some of them, we had the incidents back in 2022 where we had to deal with particular leveraged, the LDI funds, but it's not the leverage so much as what it means, as Andrew was emphasising, for liquidity, particularly if you're getting towards more crisis situations, because you tend to get all these features can then exacerbate the original moves. You get jumps to illiquidity as a result of banks calling in the contracts, hedge funds having to therefore potentially delever, and that was the key insight from last year's system-wide exploratory scenario, that the fact is that banks told us that they would pull back from providing the liquidity in the stress situation. And so in a world now, compared to the world that we had when we conducted that first Suez, where hedge funds have built up much more indebted positions in those repo markets, it is a vulnerability. This is exactly why one of the key drivers for us publishing a discussion paper on gilt repo resilience last year, which, again, I referred to this in my speech last week, but we're having a very healthy but intense engagement with the industry, with the trade bodies on these issues, because I think we look at this issue, which, as I say, in good times is a feature, but given the increase in financial stability risks, given the world we're living in, I don't think we can the status quo here is not an option. So we've made some proposals, and I think this will be of ongoing interest for you as a committee.
And on the potential crisis risk, is do you see the collapse of First Brand and Tricolor in the US as isolated, or could there be wider systemic problems for US companies?
That's a slightly different point, because that's about private assets rather than about sort of leverage in government bond markets and hedge funds. Well, on that, let's take that question. So, I mean, look, the private asset world has grown very rapidly, and it's continuing to grow, by the way. I mean, it has quite a few features to it. There is leverage in there. And by the way, so private assets, I'd say credit and equity here. There is leverage in there. There is opacity because it's not public in the same way. There is reliance on rating agencies. We've seen that before. Now, so we've had these two cases in the US, First Brands and Tricolor. I've said before, I think it raises the question: are these two things idiosyncratic, or are they giving us a broader message? I think I use the phrase "canary in the coal mine." I think, and this is why we've done a lot of work, and the PRA has done a lot of work, both in the insurance world and the banking world, on these markets. But it's why we need to do more work. It's why we've announced the system-wide exploratory scenario. What I would say so far is I think the reaction to raising these comments, I'm not the only person who has said it, is you get a lot back saying, no, they're idiosyncratic, and here's why. Here's the particular features of these things. Now, what I would say to that is, I don't think that fully answers the question, because it's all very well saying, well, there are particular features of those things, but the question is, are those features matched across other parts of the market or not? And that's what we need to explore.
Do you think, I mean, if we saw factoring a big issue with the green seal, factoring, buying other people's debt and invoices and settling them.
Yes.
Do you see that it's not really regulated? Do you think there's a need for regulation? And I'll perhaps come to you, and then Liz Oakes.
Well, I mean, obviously, as it always does, begs questions about things like auditing standards. I mean, I don't think regulation has to be the only answer to this question. I mean, I think it does beg questions about if you've got what looks like irregularities. Obviously, we're not that.
There's a whole business model for. I mean, green seal.
How was this? How was this being given audits? Yeah.
Liz Oakes, have you got any thoughts on this?
I think I probably, with many people, share concerns around the quality of invoicing systems, and a lot of it, unfortunately, comes back to things like identity management systems for companies as well as individuals. We've seen, it's a target for fraud, just because you can, and so putting better controls, better standards around the use of invoicing. E-invoicing is mandatory in many countries around the world, so this is not something we're going to be stepping away from. I think the
but what about the thing about the issue of people selling on customer invoices? So so that and they making that's their money making model. Yeah. Do you think any risks there? Because green seal was an egregious case, but we've now had two examples in the US.
I think like any other system, there are risks associated with it, and we have to put controls around it. But at the end of the day, it is a very, very valuable method for financing for many companies that we would struggle without it. I think it's been particularly constructive for supply chain management.
Thank you very much. John Grady, MP.
Yeah, thank you very much, Dame Meg. A question for Ms Oakes and Mr Hall. Looking from the outside in, when it comes to private markets and NBFIs and all the rest of it, do you feel that the bank has enough information and knowledge to correctly assess the financial stability risks arising from private markets? Maybe start with Ms Oakes and then move on to Mr Hall.
Thank you. It is a super interesting question that starts from the premise that the private markets are not regulated by the bank.
Yes, of course.
So starting
it's from a financial stability point of view.
Yes. So starting from that point, I think it's a moment in time where we need to really look at: do we have access to enough data? Do we understand how the complexities of the system have actually evolved? This is a market that has, grown exponentially since the last financial crisis, and so it's a good moment in time to figure out now, okay, so what are the interconnectedness features? How does the complexity actually layer onto the rest of the banking market? And I think we understand at a high level how this works. Having said that, then there's the complexity of people's behaviours. So I think the behaviours, the incentives and rewards in this market are different to the way the banking market has evolved. So that's something that, by definition, it would be very difficult for us to foresee how those market participants might interact with the banking market based on our understanding of how the banking market operates. So I think it's a really interesting moment to look at that in more detail. I wouldn't expect the bank to actually, or any of the regulatory authorities, to have that in-depth knowledge from an outside standpoint. It's just not something that they have had the resources or the time or the focus to deal with up to this point.
Is it your position, before we move on to Mr. Hall, that whilst you wouldn't expect them at the moment to have that kind of understanding, you think that we need to set about getting that type of understanding within the regulatory world of the bank and the FCA and so on?
I think yes, because given that it's about 50% of the market, there has to come a point in which we have to at least understand what we're looking at, so that we can actually then make a decision as to whether we need to do anything about that.
And given that it's 50% of the market, we spent a lot of time at the beginning of this session talking about banks and regulation of banks. But a big change over the last couple of decades has been the growth of these private markets. Do you see this as being a task of some urgency?
I think we'll never know until something actually happens. We always look back in hindsight and kind of go, we should have done that earlier. It's a very complex area to tackle, so I don't think it's something that you can rush into and come out with an answer in a very short space of time. But ultimately, there's a reason that, given that we don't regulate it as highly, in the same way, that it's been able to grow. And I think, I look at it from the economic standpoint of it actually underpins lending into, the vast majority of the economy at this point. So it comes with plus and minuses. Yeah. We need to figure it out, but also I don't want to contain that exuberance.
Mr. Hall, and then briefly,
Mr. Hall.
So David.
Yeah, so I do think, there has been a sort of sustained effort from the bank to really focus on this, and I think the actual progress that's been made has been quite substantial, and we're working on this for 2.5 years, and the first place to sort of focus on is areas where we do regulate. So, for example, the banks and the insurance companies. Yeah. So there's been, we put out stuff about reinsurance risks, how that relates to sort of the pension buyouts. And the PRA has been very focused on that with insurance companies themselves. And then also on the banking side, there's been a lot of work and looking at the different ways that banks do give leverage to the sort of private markets. And that's at multiple levels, from the sort of general partner all the way down to the underlying company itself, which is highly leveraged. And so not only have we done that analysis and really sort of understood that, but that was incorporated in the stress test that we ran last year, with quite significant kind of private market stress being very specifically asked about. And so the good thing about stress tests is it's not only that we get to look at it, but also we really kind of tell the industry, like, this is something you need to be very focused on, and we're on. And then the final piece of this, which sort of gets into this area, well, we don't regulate them, but the SWES is an area where we can actually engage with these firms directly, even though we don't regulate them. And so that's, the next stage of this, but it's complementary to the work we're doing with banks and insurance. And I'm very excited about what we can learn through the SWES. And of course, we'll know more after having done that with those firms than we know now. But I do think in terms of the timeline and the focus, it has been appropriate, and there has been quite a lot of progress over the last 2.5 years.
Just very, very briefly, I mean, I know that the financial stability report this time round was pretty chunky, but I would recommend the whole of Section 6, which covered all the work that we're doing in this space, and we have been, it's the resilience of market-based finance. I mean, it comes back to, we are a relatively small open economy with a huge financial sector with ever-increasing interconnections. And it's probably fair to say that we, through the Financial Stability Board, and not just when Andrew's been chair, but when Mark Carney was chair, we have always driven this NBFI agenda, this focus on market-based finance, because we are particularly exposed. We saw back to the 2022 LDI crisis how a small part of the NBFI sector linking back into core markets, the challenges then. And as John has just set out, I mean, there is a really, I would say, a very comprehensive agenda around not just the system-wide exploratory scenario, which is it's a real milestone thing that we've started to do. It is every 2 years. It has this 2 stages where you have this, it allows you to interact with these non-bank financial institutions that we wouldn't normally. And they see the incentive of doing it with us because they want to show that they're resilient. But they also want to understand what the rest of the system looks like, which they learn from us being the convener and the coordinator. But equally, as I think you've heard from us, every day we are monitoring the markets and what these NBFIs, how they're interacting with the market. So I don't want you to get any sense that we're waiting, and sitting on our hands. We're very on this.
Okay, thank you very much indeed. Yuan Yang MP.
Thank you, Chair. In your report, you write that there are still pockets of vulnerability when it comes to UK corporate debt among SMEs and highly leveraged corporates, including private equity-backed businesses. I was wondering if one of the external members might want to describe what particular concerns they may have concerning those SMEs and also private equity-backed businesses. Mr. Hall, is that?
Yeah, so I think there's obviously this broad message which has been pretty much consistent over the last sort of 18 months or so, which is, there's these sort of vulnerabilities, maybe market vulnerabilities, and credit spreads, for example, very, very tight. Sort of equity assets, as we've talked about, are stretched. But then against that, you look at the UK domestic economy. And actually, households and corporates in aggregate are actually in a pretty good shape. Relatively low debt, definitely able to service that debt. But then obviously there's this sort of counter that's the aggregate position. But if you go down into the weeds, there are some corporates that are more exposed than others, and those in particular are the ones that are leveraged. And so there's this theme of kind of the leverage risk that goes from the markets to the corporates. And both in this private markets, but also the corporates themselves, they effectively, when they're leveraged, they have to roll over their debt. And so you look at this sort of debt maturity wall, and are they going to be able to sort of roll that over? And obviously at the moment the markets are sort of open, and if anything, interest rates have been coming sort of gently lower, and so they have been able to roll over that debt. But obviously the reason it's a vulnerability is that if you do get sort of market stress and spreads either widening or actually the market kind of shutting in terms of maturity of debt rollover, then obviously they become vulnerable. So that's why we use that language. So they're sort of vulnerable to changes in the debt credit cycle.
The assessment you gave, I think, is one that could be general about any point in time facing those highly leveraged companies. I was wondering if there are particular vulnerabilities that you see facing SMEs and private equity-backed businesses right now in 2026.
I don't think so. I think we've been through some periods when credit, obviously interest rates rose quite significantly over a sort of 2-year period. So at that point, the question was, could they sustain their business model with the higher interest rate payments? So that was kind of one thing we've come through, and then we've had a couple of spells when markets have shut down, whether for IPOs, for example, or the risk was that they might do for debt. But actually, what we have seen is pretty consistently, debt markets have remained open, and so the worry would be, if there's a shock that shuts the market, then they're exposed, rather than us seeing something specifically at the moment that concerns us.
Thank you very much, Ms. Yang. Bobby Dean, MP.
And then turning to households, and we've covered this a little bit in other meetings around MPC about this sort of savings ratio remaining elevated. Do we think this kind of is a result of some sort of shock stickiness? We've had COVID, we've had Ukraine, we've had other things, and people generally have low expectations of their wages going up, but high expectations that their bills will continue to go up, whether it's energy, mortgages, rent, and so on. Is that what you think is behind it? And what do you think about the impact of this savings ratio on financial stability?
Well, take it in reverse. I mean, obviously, households building savings does increase their resilience. So, from the point of view of financial stability, that's not a negative. On the question of why, I mean, it's a question we've looked at particularly in the monetary policy context a lot and continue to do so. I think when the surveys that are done, one of the things that does come back is actually that households are responding to what I might call more generalised uncertainty. I distinguish that from sometimes in history we've had very specific concerns about job security. It's actually the moment that the answers we get are more to do with generalised uncertainty, which might be sort of consistent with the geopolitical type sort of, uncertainty that is around. It would be. So that's one thing. The second thing I would say is that I think we've also you do get the answer that we've obviously raised the official interest rate substantially since the period when it was near zero, and that has also had some effect on households' decisions on savings. In other words, the returns they earn. So I think those are the two arguments I get. I mean, the only thing I would add to this, just it's a bit of an obvious point, but I think it's worth saying. Of course, what we're looking at there is the average across the economy. There are, of course, quite large sections of the population that are not in a position where they are able to increase their savings. I mean, if you look at, for instance, those in the rental sector who tend to be lower income, you do not find the same story.
And then just in the aggregate, because of course you say it's a good thing for financial stability in general if people's debt levels are low and they're increasing their savings, but in terms of growth, if businesses aren't borrowing to invest and consumers aren't spending, is that going to potentially be a drag on growth?
Yes, it does. Well, yes. I mean, that's true. I mean, you just alluded to it actually, which is that going back to the points we were discussing about the government debt market. I mean, what we've seen over the last 15 years in terms of overall debt ratios is, again, the UK is not unusual in this respect. That government debt has increased, but private sector, and I'm talking about both households and companies, actually have not increased their indebtedness by anything like the same. So their debt positions have actually become easier, if anything. And this is relevant in the monetary policy context and financial stability context, because when we increased interest rates from basically nothing to 5%, obviously there would be concern about affordability. But because of household and corporate debt levels, that issue has not arisen, actually. Yeah. I mean, we've seen debt servicing levels remain, by historical standards, quite muted.
And if I could just
so Dave Ramsey.
add to this, I mean, I think you can look at the sort of structural savings investment position, and then the more cyclical one. And of course, structurally, if there's more savings taking place, then there's more funding available for investment. This comes back to some wider agendas, the reforms we made for Solvency UK, other reforms to encourage, those large stocks of assets held by pension funds and life insurance to try and get those back into the productive economy and put to use. And we're tracking. Engaging with the industries and tracking to see if those reforms are bearing fruit. But then there's the cyclical point, which is also relevant. Given the current heightened uncertainty, savings are higher than household savings. It is, as Andrew says, very diverse across the population. But you do have those higher up in the income distribution are saving more. Those at the bottom are really, not saving. Quite often they're having to, live and work, from day to day, as it were. But it's, if that saving rate, and we are seeing in the latest data that the saving ratio is coming off again, and we have forecast that as the MPC, and that will, we think, over time, be one of the things that in the central forecast supports the gradual growth that we're forecasting. However, we also put out more of a downside scenario before Christmas, where in the last time we published forecasts and scenarios in November, where the savings ratio doesn't come back, and that might be because of worries about the labour market, or for other reasons, for a precautionary saving. And in that case, the kind of current level of demand would be lower. And so that would be a risk that would give us a downside risk to whether or not we're going to hit the inflation target in the medium term. So there's both this structural point about the role of savings, but then a more cyclical point.
Thank you, Mr. Dean. John Glenn, MP.
Yes, could I take forward the conversation around what you see is necessary to get more investment in high growth firms? So I think that's a universal imperative in the economy. The Chancellor's given some instruction on that. And you've obviously got to reconcile the stability imperative around that enablement. And the whole Solvency UK, Solvency II, which basically reclassified the sorts of safe assets that insurance companies could invest in is understood. But we still seem to have a long way to go in this regard. If you look at some of the headline data, I think DC firms have about 5% invested in private equity, which is the sort of source of patient capital. How do you see this problem being resolved? Because we have a massive, massive difference compared to what we see in the US, even if we are reasonably high against Europe.
And it's important because we have a relatively low investment rate in the economy, and have done for a long time, actually. Well, as you and I have discussed many times in the past when you were in government, I do think there are issues in the pension system. I mean, I think it's interesting that with one or two sort of differences on specific points, I think broadly, as I look at it, the policy of this government towards reform in the pension system is pretty similar to the policy of the previous government, actually, in terms of what needs to be done. I think you're absolutely right to point to this question about the behaviour of pension funds. And I think one of the problems is that I think the system is too fragmented.
That takes time to consolidate.
Yeah, and the consequence of that is that smaller pension funds obviously have sort of diseconomies of scale. And one of the consequences of diseconomies of scale is that it's more difficult to manage risk. I mean, obviously risky assets take more management in that sense. I mean, they take more assessment, more management, and so forth. There's a tendency to want to hold gilts, for instance. I mean, hold low risk assets, and that is probably dragging back, as you said, the level of investment in risky assets, and we do need it to go. So I think, as the government I know has got proposals on, I think consolidation in that world is one of the features. But I think you just alluded to it, and I would agree with you. I say this to many ministers. It's heavy lifting. I'm afraid reforming the pension system in this way is a lot of heavy lifting, but it's got to be done. It may not pay off, instantly, but it really needs doing, because it is a problem in this country.
So I acknowledge that anyone sensible can see that you can't consolidate things overnight. But is there anything more that can be done that hasn't been done to accelerate this? Because some of the sort of figures are quite stark in terms of the different profile of investment in these high growth firms, and is material to the sort of confidence in the economy.
I think there are more things that can be done. I mean, I think a number of things have been done. I mean, we were involved in creating the TLAF, wasn't it? I think, if I remember rightly, the long-term asset class. Yeah. I think the British Business Bank is now playing a much bigger role, and I think there is a sort of role for co-financing here between public and private sector. I think the Business Bank is playing a much bigger role now than it did in the past, and that's a good thing. We are, for instance, involved in work in the context of the overall government initiatives, for instance, to look at instruments which, can we create assets where the security is on intellectual property, because, again, if you go back to things like AI, that's an important part of it. So I think we should never stop looking at areas where we can innovate to sort of improve this, alongside doing this sort of what I call fundamental heavy lifting.
Yeah, no, I think all I would add to that is, again, given this is we're talking about the FPC here. Yeah. We've tried. We were asked when we were set the updated remit back at the end of 2024 to come back and to look across the piece at what was happening on the growth front, and in terms of our policies and our interactions as the FPC. And we put out what we tried to do in this financial stability report is shine a light particularly on these high growth firms and the challenges they face, but we're doing that in the context obviously where our primary responsibility is for the stability of the system, but where, I mean, it comes back to something that was discussed earlier. We're not we're not just saying, well, that is our job. Yeah, we can't stop there. We've also can shine a light on where there are still obstacles. We highlight, you've mentioned some of the really striking, differences. The UK has the third largest venture capital market in the world and a growing venture debt market, but UK venture capital investment represented 0.7% of GDP, 10% less than the US. So those kind of really striking stylized facts, back to we talked about how complex the system is, but the funding ecosystem for funders and founders is really complex to navigate. So how can that be helped? And then, as Andrew's saying, can we use, can HGFs, high growth firms, secure lending using intellectual property as collateral? These are particular obstacles that the FPC has identified to the supply of debt and equity finance. But we don't necessarily hold the levers, but I think by shining a light on these things, we're sort of going with the grain of what the government is doing, what the system should want to do to improve things.
Indeed, there's a long-term changes to take. Ms. Oakes.
I just thought I'd add, I had the pleasure last week of going on an agency visit up north and met with some of the people who are engaged in this in this sector. And it was very much a reiteration of some of the things that Sir Dave has said. Some of it is actually, though, it's the hard yards. So it's identifying how do you help, first of all, smaller organisations as they start. So one of the issues that was highlighted was signposting. So in the past, people would maybe go along to a high street bank looking for funding for their startup or their small business. And nowadays, that's not how it works. So the role of brokers was highlighted, the role of people who understand how these businesses function and what it is that are the constraints that they might perceive, but also where are the options for funding and the agility with which some people can make decisions. So there was a contrast between a bank that is doing funding for slightly larger companies versus somebody who is actually actively engaging with some of these startup and scaling companies. And absolutely, the answers lie in having the people who can do due diligence on the lending, understanding how the financing of the business has been set up so far, whether it's debt versus equity, so they seem to be very skewed in one direction. I also met with the Wealth Fund and people working with the British Business Bank and the enterprise funds, and there was huge support in the room for that activity. But simply that we need to scale it up itself. They don't have access to enough funding, and also that they are quite often perceived as being the prime in any funding event. So people have confidence to invest when they see that the government is there and has done the due diligence. So a lot of those funding organisations don't have that capacity.
Aggregation of pension funds, looking at new financial instruments that look at things like intellectual capital as something that you can invest against, and improving market awareness. That's basically what you've all said.
I think definitely signposting. Small businesses and founders don't know where they can get access to funding, and they spend a lot of time. What we heard back was that they go and see 5 or 6 or 7 banks or what they thought
and they were never going to be fruitful in the first place.
They're never going to find the right place to get the right funding.
So is the government doing enough to create the sort of information flows to those possible new opportunities for funding?
I honestly don't know the answer to that. In that I came away with
I'm not trying to be difficult.
something
we
to
did
investigate
myself.
In our National Wealth Fund report, we did highlight that it needs to grow. I'm going to bring in Mr. Coughlin very briefly.
Just on that, Mr. Bailey, of course, part of the problem is the supply of finance, but to what extent is the problem that the investment ecosystem isn't there, the clustering effect that you have in Silicon Valley isn't in the UK, and the infrastructure isn't there. So maybe it's not so much the supply of finance, but if the attractive investments aren't there in the first place, surely it's no wonder that companies go off to Silicon Valley.
I think, as we were saying earlier, I think there are signs of progress. I'll come back to make the point about the British Business Bank. I think they really have changed their approach for the better. But one of the striking numbers that gets quoted quite a bit is the very low level of pension fund investment in venture capital. Now, Mr. Glenn's right. That's only going to happen if you have a whole infrastructure that sort of enables that to happen. You've got some instrument structures that enable it to happen, and it's not happening in this country yet. So I think if you said to me areas that need to be worked on, I think that's one. I think it's well known. I don't think it's a great revelation, but it's well known. But there are particular areas I think we should be focused on. Yes.
Yeah, thank you. Well, I'm bringing Mr. Dixon very.
Thank you, Dame. Meg, just a quick question on pension regulation. We're now coming up to nearly the 3-year anniversary of the FPC recommending that the pension regulator should include financial stability considerations in the way it supervises the industry. That hasn't happened thus far. They're not implementing that. Could you just give me a commentary on where we are on that and whether any consumers are at risk as a result of that not being
can I draw a distinction between what's happening in practice and the sort of form? Both are important, by the way. In practice, we're working very closely with the pensions regulator, and I want to be very clear that I think that's working well. I think they're doing a lot. And it's a good relationship, and there's no issue I see with them that they in any sense don't agree with the objective and what's going on. So on the ground it's happening. On this particular, you're right about the recommendation. Now, what we need to have this thing finished is for the government to frankly implement it into the pension regulator's operating framework, and I think that requires some bit of legislative intervention. Hasn't happened yet, but that is a question for the government, not for us, because we can't do that. We will leave. That's why we leave the recommendation in place, and that's why you observe that it's 3 years have gone by, because we think that the only thing that would close it formally is that happening. Meanwhile, I just want to emphasise, on the ground, I think the things that need to happen are happening.
And I mean, to just give you an example, because it links back to what we were discussing earlier, when we've had, since 3 years ago, we've had these bouts of gilt market volatility, the LDI funds have fared really well, and so that's a practical example of the outcome of our really close engagement with the pension regulator, that has, through developing these resilience metrics, developing a tool for assessing their resilience to different interest rate shocks that we reported in last July's FSR, and you're seeing the benefits of the engagement on the ground. So, exactly as Andrew says, there's the sort of legislative overlay for that, as it were. But actually, we're not letting that stand in the way of just getting on and dealing with the issues.
Thank you, Mr. Dixon. Okay, thank you, Luke Murphy.
Thank you, Chair. I wanted to ask about climate risk and about the bank's capacity, but also some questions about firms. The FT reported last year that several senior staff members had resigned from the bank, saying that they'd not been empowered to take climate risk seriously as part of mainstream supervision. They also cited that staff hours and climate risk had been cut by a third, and they feared that the bank's technical capacity in this area had fallen behind that of the private sector, and that nature was a particular blind spot. I wonder whether you believe those reports are accurate, and what assessment you make of the bank's current level of technical expertise in this area.
Well, first of all, climate risk remains in the remit that we are given. It's in the remit letter, and so we do remain focused on it. I would say this, that I think probably that all the discussion we've had this morning up until now illustrates just how many other risks we've got on our plate, as it were, and how, frankly, some of them have come up the league table in the intervening period, and we obviously therefore have to balance our resources against the risks we have to cover. So we haven't sort of ignored climate risk. Probably, I would have to say, relatively speaking, other risks have come along, and therefore, probably, if you go back, a few years, we were probably able to devote more risk to it relative to other risks, whereas we are having to balance our resources more now. But we haven't ignored it. We don't in any sense sort of resolve from it.
I mean, if I could just, sorry.
So
I was just going to add on a positive note, maybe. Recently, I've certainly engaged with the climate team within the bank, and one of the questions we were looking at was, if there was a sharp correction, what would be the impact in the UK economy? And I had lengthy conversations with the team around, what would that mean for the equity markets in the UK? Because quite rightly, the team is quite often focused very much on the gilt market and the bank's kind of view of the world. And I said, well, given that we have an equity market that is comprised of lots of organisations that are exposed in the oil and gas sector, for example, what would that look like in the UK equity market? And so they came back, they went away and did the analysis, came back, really interesting, fascinating statistics and data. And so for me, it's an ongoing thing. It continues. It might not necessarily get highlighted in all of our reports because there's just so much else, as Mr. Bailey said, going on.
And I was just going to, if I can just add to what Liz and Andrew have said. I mean, we do have, we've got section 7 of the report, structural changes in the UK financial system. There's a whole section in that on climate-related risks. Probably compared to when I started my term at the Bank of England, back in 2017, that's less than we would have had then, but that's because other risks have had to be foregrounded given the shocks we've had to deal with, both global and domestic. But I mean, my Deputy Governor colleague, Sarah Breeden, actually gave a speech recently where she said that there's increasing evidence that climate-related risks are starting to materialise in the time horizons that we look at. So you think about Mark Carney used to talk about the tragedy of the horizon, and it was never close enough. That's it is now coming, it is becoming into our time frames. So we remain incredibly focused on this. We have decent capacity within the bank that can focus on climate-specific risks. They've engaged with Liz recently. They may not be as front and centre as, say, when we're talking about the gilt market or gilt repo, just because of what's happened in the last few years. But that doesn't mean that we're downgrading it. It's just a relative point.
I mean, to follow up, I guess in the latest remit letter in 2023 from the previous Chancellor, compared to the additional focus, I think, I just wondered whether you acknowledge that in the latest remit letters from the current Chancellor, there has been an additional focus put on climate and nature compared to the previous, and I wonder how the bank has responded to that additional focus given in those remit letters.
Yeah, well, I mean, we will remain focused on the on the financial stability risks from climate change, and we will be, as Dave says, we will be doing work in that area. We're not ignoring it.
But has the bank responded to that additional focus in the remit?
What's different? What's changed?
What's changed?
I think, I was just going to say, look, we've got several pages of analysis that shows that we are, alongside everything else, we're doing a very,
If I may intervene, my question is, how has the bank responded to the additional focus in the remit letters from the new Chancellor on this point? Because there is an additional focus in the remit.
So maybe if I could interject, having had this conversation with the team, for me it was a question of, we go through, measuring or looking at structuring the problem, how do we monitor it, and then what do we come out with afterwards. I think we're in a different phase of that, because actually we're in the monitoring and analysis phase. And so for me, it's been about, okay, so we've moved on maybe from the initial identification of all of these risks and what happens next, to looking at very specific targeted questions. And so I think that for me it's continued, it's evolved, it's changing, but that doesn't necessarily mean that there's any less of a focus on it.
I mean, on that point, I guess in your questionnaire in response to this committee, you talked about the importance of the climate biennial exploratory scenario that was held in 2021. I can't help but notice the word as biennial is used, and we're in 2026. I just wondered whether the bank had a plan to renew that scenario.
Can I come in on? I mean, we are a public body. Although we get most of our funding from the financial system through either the PRA levy or the bank levy, we do have to allocate our resources. We talked to you today about the 2 system-wide exploratory scenarios, which are pretty groundbreaking globally. We've always run climate-related scenarios. We're still part of the network for the greening the financial system, where a lot of the scenario work is now done. We've reported our latest analysis here. I think we don't sort of do a quantified assessment of the remit to check, have we done enough? I mean, I think the government will, we're held to account by you and the government. So, see if, read what we've done, see if it meets the requirements. But as I've stressed, we are now saying that these risks are within our horizon. So there is no chance of us doing any less monitoring, because they will now start to impact on markets in our horizon. And, whether that's the insurance gap or the other key concerns that we currently have about, climate change related risks. So all I can do is give you the assurance that we are very focused on this and we remain accountable for what we're doing.
So just on the specific point of CBES, though, is the intention not to do that because you think it's not to renew that particular scenario?
CBES is a cyber.
The climate biennial.
That's different from
CBES is cyber.
So the climate biennial exploratory scenario that was done in 2021.
Well, look, as David said, I mean, we will come back to it, but we've had to prioritise other exploratory scenarios in the meantime because of the nature of the risks that has come up. And as we were saying earlier, the next one the one we're doing now is private assets.
Just very quickly moving on to firms. In 2024, Sarah Breeden told us that firms have done a lot to mitigate the risks of climate change, but there is still a huge amount to do. I just wonder whether you could sort of set out what progress you think firms have made in 2025 in mitigating the risks of climate change and what more they have to do.
Well, I think we should mention, obviously, there's a bit of an elephant in this room as well. Look, I think domestically, I think firms continue to do the things that they've been doing, and I think they are working very much consistently with government policy. The elephant, obviously, is that internationally, this is a much more challenging and difficult environment to operate in, and I see this wearing my other hat as chair of the Financial Stability Board. I mean, there was, as you know, there is one major jurisdiction which is not prepared to engage on this subject, and that has it, and it's had an effect for firms. Firms have to think very hard now about how they operate in that world.
But just on the specifics, I mean, admittedly, it's on page 138 of the Financial Stability Report.
Every page is important.
But, it sets out, the recent data collection that the bank and the PRA did that shows the presence of climate risks in major UK banks, current wholesale and residential real estate exposures could lead to financial losses. And it also talks about the importance of, more in the, their high loan-to-value mortgage lending. Around half of banks' high-to-loan-value mortgage lending to properties with EPC bands D or below. And so, this comes back to the losses they could face on those kind of exposures. So this, to say that this has become, there's always this term that's used, kind of business as usual. Obviously, nothing about climate risks is business as usual because it's an existential threat and it's coming closer. But in terms of the way we now approach it, we have moved on from the kind of exploratory scenarios in terms of, we're mainstreaming the work domestically in the way that once we've done the private credit exploratory scenario, we will hope, those big one-off set pieces, they then get mainstreamed. But just because I'm describing it as mainstreaming, that doesn't mean it's any less important. It just has to be prioritised alongside everything else in a world where, as we've said, the financial stability risks are increasing.
Thank you very much.
Very much.
Thank you, Chair. Governor, I seem to recall that 2026 was the year in which you would make a go or no-go decision at the bank on the Brit coin. So could you update us on that?
Well, by the way, I mean, any decision is actually for the government, ultimately not for us. I think that was the way it set out, and indeed it would come to Parliament. I think that was always the agreement.
If they decided go tomorrow, then it
would
go.
I think what's happened is that the world has moved on to a considerable degree and in this particular area. And let me set out sort of, I think, the two things that are moving. And I preface this by saying, as I said before, that I think the most important thing here in this world is that we get the benefits of digital technology into the payment system, into the money system in that sense. So the question is, how do we do it? Do we do it by creating a new form of digital central bank money? What role are so-called stable coins going to play in that world? And then the third one is it achieved by incorporating digital technology into the commercial bank money system and commercial bank payment systems? Those are the choices, broadly speaking. We continue to work on the central bank one, but we're also working on the other two. And I think that the area that I've been very keen to, frankly, move forward is with the commercial banks, because most of the stock of money for payments purposes is held in all of our bank accounts.
I'm going to move on to that.
And so
we
are relatively now bringing that one alongside, because I think the decision is to some degree going to be, which one of these two do we prioritise?
And I'm going to ask some questions about the commercial banks and other stable coins and so on. But specifically on the Bitcoin, the Bank of England digital currency, on which you did a consultation.
Yes.
You've spent presumably a lot of money. How much has been spent so far on the systems development?
Well, we've done the design phase.
Yeah.
We were always, if I can come in, Dame Harriet, we were always very clear that we consulted on digital monies. So it was the possibility of a central bank digital currency alongside the alternatives.
We're also doing a lot of background work on implementation, which was due in 2026.
Well,
so that's why I'm.
Can I just
asking
be
for
very
an
clear
update.
that I understand where you're going, but there's a bit of an implication there that any money, let's say we don't do central bank digital currency, that we've wasted a load of spending. And that would not be the case, because the benefits of that in terms of understanding the technology applied would go into whatever we do. So that's, I mean, look. But
if you've got money that you spent, you can write to us about it.
Yeah.
Sorry?
It'd be helpful just if you wrote to us about the money that's been spent.
I could do that, yes, okay. But we are relatively, at the moment, I'm very keen that the commercial banks working with us determine what can be done in that world, because I do think we have to come back to the question, do we need to create a new form of central bank money to achieve what we want to achieve here? That's the question.
Okay, so if the government decided tomorrow, because it is 2026 now, that they did want to go down that route, would you be ready to do it?
We would move forward to go to the next stage.
And you're right to tell us how much you've put in.
We would be ready to go to the next stage, which would be taking it forward in terms of design and trialling.
So how long would that take if the government gave you the green light, in the next before Easter?
Well, can I give you? We've talked before about the real-time gross settlement system, which is our biggest ever tech build, which has just been reviewed by the National Audit Office, and I'll be appearing in front of the Public Accounts Committee in March on that. I mean, that was 8 years, and that was a big wholesale build. Hundreds of millions of pounds spent, millions of tech hours. I think this would be I'm not going to give you a time frame, but I would suspect, depending on what the design and all the feasibility studies show, this would be a comparable exercise, if not bigger.
That's right. That's roughly.
So what I'm hearing is that you're focusing more at the moment on working with the private sector in terms of how this technology can be used more in our payment systems. Would that be a correct interpretation of what you said?
I want to see what can be done in that world, what they can do, and that work is moving forwards, yes.
Now, there's clearly been a shift in the US in terms of their embrace of this technology under the current administration. And I wonder if you're happy, Governor, with the way in which stablecoins are being regulated in the US at the moment.
Well, of course, we're actually still waiting to see a lot of what is going to happen in the US. So just to be clear, the US has passed one piece of legislation. There is a second piece of legislation that's required, which is, I think, currently rather jammed in Congress. And then they have to go to the point of regulatory proposals, consultations and rulemaking. We've already got to that stage. Some people keep saying that we're behind the US. We're actually in front of the US in that respect. Now, on the substance of it, therefore, obviously, we have to see what they do on that front. In terms of, obviously, there are more dollar stable coins around at the moment than there are sterling stable coins. The US has developed it without this regulatory framework. I think there are some aspects of the current practice in the US that I think is going to come under a lot of scrutiny but we'll see whether the legislation in the US changes it. So give you an example, which I think is important, as I understand it with the major dollar stable coins at the moment. There isn't necessarily an option for a holder to exit into what I call fiat money, into a bank account, let's say, through a payment system with a guaranteed nominal rate of exit. In other words, $1 there is going to be $1 there. You go through a crypto exchange and you get the proceeds of the process. I don't see how that is consistent with the definition of money. So I think these sorts of questions are going to have to be settled.
Okay.
Because I think one of the absolutely core features of money is the assured nominal value. Because if I'm going to pay you £1, you want to know that £1 in your bank account is the same as £1 in my bank account.
Will the outcome of the Bank of England's consultation on stable coins then resolve this with clarity?
Ours is for sterling stable coins.
Sterling stable coins.
Yes, it will. Yes.
And I note in your consultation that you've described some issuers who are considered systemic at launch. Can you give me an example of who would be considered systemic?
Well, if a very big player came into the market, I think we would take the view that the business plan they had was so substantial that they were intending to be systemic from launch.
Okay.
Because I don't think.
Aren't any at the moment. Yeah.
Not at the moment. No.
Okay.
Okay. And then final question, if I may, Chair. I believe that the Bank of England is custodian of a lot of the gold that belongs to Venezuela.
Yes.
Can you update us on what's going
on there? I can. So a bit of history, if you don't mind. So if you go back, I think I might say about 7, 8, 9 years now, the UK government de-recognised the Maduro regime in Venezuela and recognised something called the Guaido regime at that point.
This is before your time, so that's why you're having to...
Yes. We then faced, some time afterwards, a year or two afterwards, the Maduro regime sought to sell the gold reserves that we hold from them. And of course, we had to point out to them that actually, as the UK government did not recognise them as the government of Venezuela, we couldn't actually act upon that instruction. That led to litigation starting. That litigation has essentially always been run by the government because the issue is actually over the recognition of Venezuela by the UK government. Now, the position has moved on a bit over the years because, as I understand it, I don't think the UK government currently recognises any regime because I think Mr. Guaido has left the country. He's not recognised. Maduro obviously wasn't recognised from that point onwards. And it has been in the courts ever since. The case is actually stayed at the moment. Neither the Maduro regime nor the Guaido regime or representatives of it and their lawyers are taking it forwards. And so the gold remains with us.
How much gold do you have in your vaults from Venezuela?
Sorry,
How much gold is there in your vaults from Venezuela, Governor?
I can't give you a current value, I'm afraid. I'm not. I'd be a bit careful on commercial confidentiality here as well.
We can share with you the information that's been shared with court because obviously all our customer banking relationships are deeply confconfidential and rely on that. But this one is in the court, so we can share with you.
We can take that offline.
But we do.
So it's essentially stalled.
And same question about Iran.
So,
same question about Iran. Do you have any Iranian?
No, we don't have any Iranian.
Okay.
Thank you very much, Dame Harriet. Ewan Young MP.
Thank you, Chair. Finishing on my favourite topic, quantitative tightening. Since we last met, the MPCs cut the annual pace of quantitative tightening, as you know, overall from 100 billion to 70 billion pounds a year, at the same time increasing active sales of gilts. Ms. Oakes, do you think that this overall package will improve gilt market stability or have no effect either way on gilt market stability?
So the FPC was consulted as part of the decision-making process, and obviously our view on that is solely related to financial stability overall. My concern at the time was more, could the market deal with or absorb the levels which the MPC was proposing to go with. I'm very happy with how that has been resolved. I don't think that it exacerbates financial stability. It appears to have gone off without incident or any, Dave, correct me, any structural shift. So from my perspective, very happy with how that's been managed and handled.
Was your concern at the time about the active sales and the rate of absorption? Is that what you were saying?
Yes, yes, whether that would cause any discontinuity in the market or disruption in the market, and how that would be perceived more than anything else, because I think actually either pathway would have been manageable, and I think it's worked out well.
Thank you. And Mr. Hall, any other thoughts on this?
So I think at the end of the day that the possibilities, so we were briefed on the issue, but the question for us is there any financial stability reason for us to, for example, make a recommendation, and at the time there was not. So it was very much an MPC decision. In my personal view, it was a good decision, and it's worked out very well, and the market's been very stable, and it was absorbed. But for us, there's a very specific question: are there financial stability risks here? And the answer was quite clear that no, in terms of the proposals. So it wasn't our decision to make.
So the FPC was consulted but didn't give a recommendation?
It was
overall?
briefed, yeah.
Right, so there wasn't an FPC view on this overall?
So the FPC could have a view that there was a financial stability reason to do to make a certain decision, and the view was that there was not a financial stability reason for the MPC to make it, so therefore it's just purely the MPC's decision, and we're briefed on it, and we're aware of it, and I think it was a good decision. But it certainly wasn't our decision.
Okay, thank you. Thank you, Chair.
Thank you very much. Chris Coughlin, MP.
Thank you, Chair. So just following up on that, it's interesting the government chose not to tax the bank's profits on QT in the budget. I would speculate that one of the reasons for that might be lobbying by the banks about the risk to financial stability and the impact on reserves. But I saw that in 2024, the top 4 banks, UK banks, paid over 40 billion in dividends and share buybacks, i.e. probably up to 4 times more than the level of tax we were talking about. So would it be fair to say that there's unlikely to be a risk to financial stability if the government did choose to tax windfall profits from QT on the banks?
I don't have a strong view on that, I'm afraid.
I challenge this because I think there's I do disagree on this point. Banks have to earn their cost of capital. And as part of the valuation of banks, they do have to pay dividends to their shareholders. They have to pay returns to their shareholders. Now, we're now, 15 years or so on, more than 15 years now on from the financial crisis, and we have got the UK banking system back to the point where it does earn its cost of capital. It's only recently that it's got to that point, actually. It's been a long haul. And you can see that reflected in the market valuations. The market valuations of UK banks are now above unity with their book value. Not much above, but they're above, which is where they should be, and that's how they can then raise capital if they need to raise capital. Now, a large part of the of earning their cost of capital is their net interest margins. That's the way that's the big driver of bank earnings. So I'll be like that. If we were not to pay interest on reserves, that would affect that. By the way,
I wasn't talking about not paying interest on reserves. I was talking about purely
on reserves that they hold with us.
Yeah, so I wasn't asking about that.
Yeah. And frankly, they would have to take other measures to earn their cost of capital. So that's a long way of saying that, frankly, it would affect customers in terms of either the cost of borrowing or the amount paid on saving. My aim always is that our balance sheet is essentially neutral in this respect. I mean, we've got bank rate on both sides of our balance sheet, so that when we pay interest on reserves, we're also increasingly funding those reserves. They're being funded through repo operations, which have the same interest rate. That's, I think, neutral from the Bank of England's point of view and neutral from the public balance sheet point of view. But I would just emphasise this point because I think it gets misunderstood. When you say, well, there's 40 billion for grabs there. No, it would have a big consequence if we were not paying interest on reserves.
And they are, the other thing, if I can just add it, that reserves with us are that they are the ultimate liquid asset.
Yeah.
So we've done surveys. I've discussed these with you, including most recently in December. Our regular surveys, and we've had some exchanges about whether we should augment the surveys we've done, show that they for liquidity management purposes, that they have a desire to hold a significant number of reserves with us, many more than before the global financial crisis, because that was a huge learning point from that there were not enough reserves in the system. And as Andrew says, if we stopped remunerating those reserves, or some proportion of them, those would shrink, and that would create a financial stability risk.
A reduction, a reduction in a dividend payment would have no impact on reserves. I understand your point about it would impact their share prices, but share prices have rocketed in recent years, but B, bank customers are also taxpayers.
Hang on, let's go back to the point I was making earlier. When you say share prices have rocketed, that's the part of getting the banking system back to the point where its market value and its book value are essentially the same. Now, I do understand that the cash numbers involved in this world are big. UK bank share prices have risen, but that's got them back to having essentially it's about 1.2, I think, at the moment. For a long time, their market values were trading below their book values. That's not a sustainable position in the long term to have. So we've seen that adjustment. And I just re-emphasise the point that Dave makes. It's a very important point. We were having this discussion earlier about liquidity in the gilt market and supporting it. It's these reserves that support that.
Absolutely. Thank you very much. One of the things we enjoy when you come in front of us is having the independent members of the FPC. With the MPC, the independent members are able to go and speak quite freely outside of MPC meetings. And I wonder if I could ask you both, I'll start with you, Liz Oakes, would you like more freedom as members of the FPC to speak outside the formal environments of the FPC meetings?
I think
so we were talking about transparency earlier, so Dave was saying how transparent and open the bank is, so it's an obvious question.
I see the way the MPC and the FPC operate are very, very different. The MPC is very much a group of people who have independent viewpoints and academic viewpoints around monetary policy. The FPC is much more, I think, collaborative, consensus building. We investigate topics, we come from different angles, but we all have, and we have often very, very different perspectives. But I think we tend to coalesce around the right answer in that sense. We bring a lot of different viewpoints together.
You don't feel curtailed in any way?
So I don't at all feel curtailed, actually. But I think also the topics are very complex and interjoined and interconnected. And so sometimes we see different layers and levels of complexity. I would say, even John and I have very different perspectives and different backgrounds and different understandings of topics, and come from different segments and sectors of the market. I'm sometimes, I can say I'm not envious of the MPC members who publish externally and the level of scrutiny that brings to their particular viewpoint on something. I actually enjoy being able to go out and talk to people in the marketplace where they know I'm not necessarily going to publish what they've just said. Because I think it gives you an ability to absorb quite complex and probably topics that are early stage. Some of the things that we discuss and discover go on for a number of years before they crystallise into something we can do something about it.
Thank you. Mr. Hall.
Yeah, no, I also am very happy with the way the sort of FPC is sort of structured and set up, and I think it's quite deliberate. And one thing that's quite clear is that in the MPC, you pretty much have the sort of same question and almost the same answer, month after month, and people bring their perspective to that. But there's some element, people might have camps like hawks and doves, for example, and you're just coming back to the same question. Whereas on the FPC, you have this incredibly diverse set of issues that we're talking about. And so what I might find is that on one topic, I might disagree with Liz, and on another one will agree. And so you don't have these sort of camps. You have very much this sort of truth-seeking, consensus-building, and in my opinion, extremely constructive process. And I certainly don't feel like that my view is in any way sort of held back from being incorporated within the maybe the opposite. It should be more, but within the sort of decision-making process. And then in terms of speeches, we do give speeches, not as many as the MPs. I gave one recently on the balance between growth and financial stability. I encourage people to read it if they have time and energy, and it would, at the very least, it will help them sleep. But in a way, it allows you to give speeches on topics that you're focused on, you're interested in, rather than the one issue that the committee is constantly. So in my experience, the committee has been very constructive, and I hope we've got to the right answers.
Of course, you reach the end of your term this August, don't you? So,
that's right.
So will you be missing
Sadly,
it?
yeah, I miss it.
Well, thank you very much for that. Look, we've had a very interesting session. I think it's almost impossible to summarise, but I think some very important points made about the international situation, and also about how we can get lending to small businesses, and of course the important issue of the discussion around household savings and challenges for them, which is obviously critical to us and our constituents. Can I thank you very much indeed for your time. The transcript of this session will be available on the website uncorrected in the next couple of days, and I want to thank our colleagues at Hansard for that, and our colleagues at Bowtie for the broadcasting, and thank our witnesses very much indeed. Thank you very much. Order.
Thank you.